Setting a clear home buying time horizon is essential to making a financially sound and emotionally satisfying decision. This process involves understanding your short-term and long-term goals, assessing market conditions, and aligning your personal circumstances with your purchase. Here's a structured approach to help you determine your optimal buying time horizon and avoid potential missteps. First, identify your short-term and long-term goals. Short-term goals, which span 1 to 5 years, might mean renting or purchasing a smaller, less expensive property if you see yourself moving or upgrading soon. Buying a property comes with upfront costs, closing fees, inspections, appraisals, and the equity you build over a short period may not cover these if you sell within 5 years. For example, if you're a young professional anticipating job transfers or major life changes, you might consider a smaller home with a low-maintenance structure, like a condo or townhome, rather than a large single-family home. A smaller home or condo requires less upkeep and can serve as an income-generating rental if you relocate. Alternatively, waiting to buy might be better until you're settled in a more permanent area. Long-term goals, which are 5 years or longer, might mean buying a property with room for growth. This approach gives you time to build equity and allows property values to appreciate. You can also feel more confident in spending on home improvements, since you're likely to benefit from the increased value when it's time to sell. For instance, if you're a growing family with young children, purchasing a home in a quality school district with enough space for the family's future needs would be a strategic choice. If you expect your family to grow or your career to remain stable in the area, investing in a single-family home might make financial sense because it fulfills both immediate needs and anticipated future demands. Next, evaluate market conditions and economic factors. Interest rates significantly impact affordability. Locking in a lower rate means lower monthly payments and less interest paid over the life of the loan. Monitoring the trend in interest rates can help you decide whether to accelerate or delay your purchase. However, keep in mind that waiting for a perfect rate may mean missing out on the right property or facing higher prices if the market appreciates quickly. For example, if mortgage rates are low but expected to rise, you may want to expedite your purchase, as locking in a low rate can lead to substantial savings over time. Conversely, if rates are high but predicted to fall, you might wait or negotiate a shorter mortgage term with the option to refinance when rates drop. Local market trends are also crucial. Research market cycles in your target area to gauge whether it's a buyer's or seller's market. Buying in a buyer's market typically gives you more negotiating power, as there's more inventory, and you may be able to secure a better deal. In a seller's market, prices are often higher, and buyers have less leverage. For instance, if you're looking to buy in a hot real estate market, you may have to make faster decisions to avoid losing out, which might mean making some concessions, like fewer contingencies, or stretching your budget slightly. However, if your time horizon allows for flexibility, you might wait until the market cools and inventory increases. Lastly, consider your financial stability and flexibility. Emergency funds and income stability are key. Buying a home requires solid financial planning, including an emergency fund. This is especially crucial if you're in a high-risk industry or self-employed. Your ideal buying time horizon should allow you to maintain a 6-month emergency fund post-purchase, covering mortgage, utilities, and maintenance costs. For example, a buyer with a stable job in healthcare might feel more comfortable purchasing during a shorter time frame, knowing their income is relatively secure. However, someone in a fluctuating income profession like commission-based sales might benefit from a longer time horizon, ensuring they have funds to cover unexpected lulls. Savings for a down payment and closing costs are also important. Rushing a home purchase without an adequate down payment could lead to higher monthly payments, PMI, private mortgage insurance, and less favorable loan terms. Waiting to save 20% for a down payment can increase affordability by reducing monthly expenses and eliminating PMI, especially if your time horizon is flexible. For instance, suppose you're currently able to save $2,000 monthly and need an additional $20,000 for a 20% down payment. You'd need a 10-month time horizon before purchasing, which could lead to better loan terms and no PMI. This patience can provide significant savings over time. Plan for future lifestyle changes, career prospects, and relocation. If there's a chance your job may require relocation within a few years, Buying now may not be ideal unless you're prepared to rent the property if you move. Factor in the time it takes to build enough equity to cover transaction costs if you need to sell sooner than expected. For example, an early career professional may find it more practical to rent in a new city initially, allowing time to assess if they want to settle in the area. Once established and confident in their job stability and satisfaction with the location, they can plan for a long-term home purchase with less risk of needing to relocate. Family planning and space needs. If you foresee your family size changing in the next few years, choose a property with room to grow, such as additional bedrooms or a backyard. While a starter home may be tempting due to lower costs, moving frequently incurs extra expenses, such as selling fees and moving costs, potentially offsetting the savings of buying a smaller property now. For instance, a couple planning to start a family might find a 2-bedroom condo economical, but if they outgrow it in a couple of years, the cost of selling and purchasing a larger home could make this decision more costly in the long run. Instead, they might consider a modest single-family home or a larger condo to accommodate their future family needs. Understand the costs of selling and buying again. Transaction costs. Each purchase and sale comes with costs: closing fees, agent commissions, inspections, appraisals, and potential repair costs to prepare a property for sale. It generally takes 3 to 5 years to build enough equity to cover these expenses, meaning that if you're likely to sell within a few years, buying may not be the most cost-effective choice. For example, if you purchase a property today for $300,000 and sell in 3 years, you might pay around 6% in agent fees plus additional closing costs, totaling around $18,000 or more. If the property's value doesn't appreciate significantly in that time, your proceeds might barely cover these costs, reducing the financial benefit of the purchase. Balance timing with preparedness. Avoid rushing due to market pressure. While it's essential to consider market conditions, avoid feeling pressured to buy before you're ready. Rushing can lead to compromises on the home's location, quality, or long-term suitability, resulting in buyer's remorse. For instance, if you're buying in a competitive market and feel pressured to make an offer, take a step back to ensure the property aligns with your long-term goals. If you're looking for a family home but find a small, expensive condo that doesn't fully meet your needs, it may be wise to wait for a more suitable opportunity. Setting your ideal home buying horizon. Your ideal home buying time horizon should allow you to save sufficiently, monitor market conditions, and align with your personal and professional plans. Typically, buying with a minimum 5-year horizon provides the most financial stability and flexibility, but this varies by individual goals and circumstances. In short, assess your stability, long-term goals, and market trends, allowing yourself adequate time to save and prepare for a well-aligned purchase. This thoughtful approach minimizes the risk of buyer's remorse, giving you confidence and satisfaction in your investment.